Our next guest says their impact is overstated and could even be deflationary. That said, Truflation's real-time inflation gauge is showing a sharp rebound over the past month. It's risen from a low of 1.2% in early April to back above 2% today. And companies that recently announced they'll raise prices include Adidas, Best Buy, Procter & Gamble, Ford, and Stanley Black & Decker. Joining me now to discuss is Vince Lorusso. He is the CEO of Clough Capital Partners. Vince, it's great to have you here this afternoon. Welcome.
Nice to be here, Kelly.
So walk us through kind of how you're thinking through the markets with bond yields where they are. We're learning what we are about retail earnings. I don't know if you're, the retail investors tend to be a pretty specific set, and I don't know if your portfolio includes any of those holdings.
Yeah, so at a high level, we're really constructive on equities. We have been for a while, and you mentioned bond yields. We think bonds are just altogether not that exciting right here. We've been in a secular bull market for bonds, as everybody knows, for close to 4 decades. The exception to that was the fiscal and monetary response to COVID, but we get back to a trajectory where we think yields go lower, especially the front end of the curve, and equities are the place to be. So within that, retail investors have actually, it looks like, done a pretty decent job staying invested, while some of the professional asset managers like us at Clough Capital have a responsibility to be a little bit more tactical. Risk-adjusted returns are really important to us at the firm. But we do think the long-term view on equities is to be quite bullish.
But it sounds like you guys were staying the course also. Or did you have to, I don't know if you were forced out of any positions in early April or if you pared back risk until we got more clarity on the tariff front?
Yeah, so we have a couple of different ETFs that I manage at Clough Capital. CBLS is a hedged equity strategy, so it does have a short book. I'd say in that strategy in particular, we've been inclined to be a little bit more tactical, get defensive, move into some more resilient type business models, maybe utilities, even gold miners. But the long-term view has us with a higher net exposure. So the long book minus the short book, we talk about a range of 30 to 70%. We've been skewing at the higher end of that range. CBSE is the long-only equity ETF that I manage, and that is fully invested. So it gives us the opportunity to invest across sectors and geographies and market caps. And we think there are really interesting opportunities in the equity market right now.
Yeah, so talk about those and also why you don't think the whole tariff song and dance is something that is dramatically impactful.
Well, we think the volatility that it induces is impactful, right? And we do have to be cognizant of that, the impact it has on our returns for our investors and for the standard deviation, and the drawdowns can be cause for some tactical maneuvers within the portfolio. But that longer term perspective is that, look, tariffs tend to be deflationary. We have some precedent for that. They act as a tax. And when you think about the permutations of tariffs, the ability to have substitution effects, the ability for supply chains to absorb some of the margin impact, and consumers to be a little bit more, kind of tactical themselves about where they spend, their hard-earned income. We think that a lot of these businesses are going to have to navigate some implications from tariffs, but we think sometimes that the impact of that are a little bit exaggerated in the marketplace. When you look at the amount of our economy that's service-based or domestically supplied, the ability of companies to migrate investment and supply chains into other areas, and frankly, at a high level, you see from a political perspective, you see a willingness to be more contemplative, to be more deliberate, to extend some of the deadlines. And I think ultimately what this president is looking to do is to bring people to the table and negotiate, which has kind of been, his operating modus for a long time. So when the markets react or overreact in the short term to tariff news, we step back and say, look, you want to be in equities. Some of the extrapolations that are being made on the impact of the economy we think are a little bit overdone. And we're using some of those pullbacks to find stocks that we like within the portfolios.
Yeah, and quickly, I want to get your specific names there before we talk about NVIDIA as well. But, I mean, many would say, look, tariffs amount to a corporate tax hike. And would you be so sanguine if we were sitting here talking about a corporate tax hike?
Well, I think a corporate tax hike would be deflationary, right? And it does have the impact of making the Fed potentially more accommodative. So while they navigate this dual mandate between growth and inflation, we think the inflation concerns are going to resolve themselves as this negotiation process plays out, as substitution effects go into force, and as consumers migrate into other products and other opportunities. So as the inflationary concerns come down, we think that the monetary policy and fiscal policies adjust to that, and they do provide, we think, a boost for equities.